gold prices plummeted by as much as 2.5% overnight, sparking a chain reaction that's now putting pressure on investors to re-evaluate their portfolios amidst a fresh wave of geopolitical tensions. The US and Iran's exchange of strikes over the weekend has sent energy prices soaring, and that's got many experts predicting another round of interest rate hikes to combat inflation. This is particularly significant because gold has long been seen as a safe haven asset, a go-to for investors looking to hedge against uncertainty and market volatility. But if gold is taking a hit, it suggests that investors are more concerned about the immediate impact of these rate hikes on their portfolios than they are about the potential for longer-term instability. The implications here are huge, because if the Fed does decide to raise rates again, it could have a ripple effect throughout the entire market. We're already seeing it in the energy sector, where prices are on the rise, and that's likely to have a profound impact on the economy as a whole. But let's take a look at what's happening on the other side of the world, where China's crude imports are poised to make a major comeback. China's decision to relax fuel export curbs and increase run rates is expected to lead to a significant jump in crude imports, with many analysts forecasting a return to strategic stockpiling later this year. This matters because China is one of the world's largest oil consumers, and its actions have a direct impact on global demand. If China is indeed ramping up its imports, it could help to offset some of the other factors that are driving energy prices higher, like the tensions between the US and Iran. But it's also worth considering the potential implications for the global economy, particularly if China's increased demand starts to drive prices even higher. Moving on, there's some fascinating news out of JPMorgan, where researchers have developed an artificial intelligence agent that's capable of outperforming the standard 60/40 investing model. This is big news, because the 60/40 model has long been seen as the gold standard for portfolio management, and if JPMorgan's AI agent can really deliver on its promise, it could be a game changer for investors. The best part is that this agent is reportedly capable of doing all this with less risk, which is music to the ears of any investor who's been burned in the past. But what's really interesting is that JPMorgan is being relatively open about how this agent works, which has some experts speculating that we might see a wave of similar tools hitting the market in the near future. As we look to the European markets, stocks are steady, with gains in the energy sector helping to offset declines in tech. This is largely a reflection of the same trends we're seeing elsewhere, with energy prices on the rise and tech struggling to find its footing. But it's also worth noting that European stocks have been relatively resilient in the face of all this uncertainty, which is a testament to the strength of the European economy. Finally, the Federal Reserve's top bank cop, Michelle Bowman, is warning the Financial Stability Board against enforcing strict rules that aren't suitable for a diverse group of countries. This is a nuanced argument, but essentially, Bowman is saying that a one-size-fits-all approach to regulation just isn't going to work, and that the FSB needs to be more flexible if it's going to be effective. This matters because the FSB plays a critical role in shaping global financial policy, and if it gets it wrong, the consequences could be severe. And that's all for now. Tune in tomorrow to find out how the latest batch of earnings reports will shake up the market.